The Rebel Capitalist Show. All right, it gives me a great deal of pleasure to bring someone to the Rebel Capitalist Show that I have a tremendous amount of respect for. He's been hugely influential on my thinking since 2012, and he needs really no introduction. His name is Peter Schiff. Peter, welcome to the Rebel Capitalist Show.
Oh, it's my pleasure to be here.
First of all, before we get into the interview, I really want to mention something. And a lot of my viewers know that I'm kind of hard on Dave Ramsey, but they don't really know why. And back in 2012, when I got into studying macro and economics and really got into your podcast and Jim Rogers and other people, I was listening to Dave Ramsey, and I won't go into what he said, but he really was hard on your father. And he called
I remember he said I was a kook. I was the son of a kook. Because that guy,
exactly.
He said, get out of stocks. And the funny part about that Dave Ramsey interview is he said, look, if this guy Schiff is right, all these different companies would have to go under. And he just mentioned the companies, and many of them did go bankrupt. And they ended up getting bailed out by the government, like General Motors. I forget some of the other ones he mentioned. But yeah, and every stock he mentioned, even if it didn't go bankrupt, was down like 80, 90%. Somebody said, well, I read Peter Schiff's book and I'm thinking about getting out of the market. It was 2008, early 8 or late 7. Oh, that'd be crazy. This guy doesn't know what he's talking about. And of course, everything that woman was worried about happened. So.
Yeah, but my point is, ever since he said that about your father, I've had a chip on my shoulder towards Dave Ramsey, because I know all my viewers are very appreciative for what you do and have a ton of respect for you, but they should have just as much respect, if not more, for your late father. He was really an American hero.
Yeah, but he's still pretty popular now. When you look at the podcasts in business, he's always number one. So he's got a popular podcast, and I guess he's got a radio show too, I suppose.
Okay, so let's dive into it here. I've got my questions written down. I wanted to be prepared. The first thing I'd really like you to explain to my viewers is it's something that the average Joe just has a really hard time understanding. And that's why currency doesn't equal purchasing power or consumption, and production and productivity does. They just see the Fed, as an example, printing this money, and they see that, well, if you deposit that money or currency into my bank account, I can buy more stuff. So doesn't that equal purchasing power? But as you've explained so many times, it doesn't. But just if you could break that down to a third grade level as to why it's all about production.
Yeah, because that's probably the level at which most U.S. high school graduates are probably reading. But your audience might be a little bit better educated than the third grade. But if you look at what's happening right now, in particular with the relief plans that are being announced regarding the coronavirus and what everybody is saying, you listen to those Democratic debates from Sunday night, and Biden and Sanders. The government's going to make everybody whole. The government's going to pay your mortgage. The government's going to pay your rent. The government's going to give you health care. The government's going to make sure you don't lose any money. And everybody is like, yeah, that's great. The government could just give everybody money, because everybody knows that the government creates the money, or the Federal Reserve creates the money. And for some reason, sometimes they're stingy with it. They don't want to share it, But during times of emergency, all of a sudden, they're going to give everybody some money. Mnuchin was saying today that, well, it's no fault of Americans that this happened. And so therefore, we want to make sure that nobody suffers, so we're going to give everybody money. Like the government is sitting on this pile of money. But, people don't want money per se. They want the things that they can buy with money. But the money is the cart. The stuff is the horse. You need to produce things. For money to have any purchasing power, there must be goods and services to purchase. Right? In the absence of goods and services, money has no value, right? If you're stranded on a desert island and you're really thirsty and hungry, and someone gives you a bunch of money, what good is it? If there's no food and there's no water, there's nothing that you could do with that money. And so for money to have value, paper money anyway, I mean, gold, real money, has intrinsic value all by itself, because you could do something with gold. You could use it. But you can't do anything with paper. You have to exchange it for something. But that means that something has to exist. So it has to be produced into existence, or somebody has to expend labor to provide you with a service. And the government can print money, but they can't create products. They don't provide services that you want. The marketplace has to do that. So when the government just creates money and nobody is doing any work to add products or services into the economy, then all they're doing is destroying the value of the money you already have. Because of the new money, the existing goods and services become more expensive to the point where there's no real purchasing power created by government printing money and giving it to the populace, which is really what they're doing now. And so people have to understand that money is simply a claim to production. But if there's no production, then it's really not a claim on anything. All it does is reduce the value of the claims that already exist.
Right. So a couple things there. I want people to understand how the transfer mechanism works from the starting point. Let's say the Fed prints money. It goes into the reserve accounts, let's say for the primary dealers. And then from that standpoint, the primary dealers, let's say they have to do something with it. They create another deposit, or the government spends it and then has to borrow the money. So that creates another deposit. And then how does that get into the real economy to where it can circulate and chase those goods?
Well, basically all that happens is the government itself, which is separate from the Fed, which is not technically part of the government, but it functions as if it was part of the government. But what happens is the government borrows money, like they just announced today, another $850 billion stimulus, whatever plan. They're going to send checks to Americans. So what happens is the U.S. government then has to sell a bond, and the dealers go out into the market and buy the bonds from the government with the money they get from the Fed. And then these dealers take the bonds and sell them back to the Fed, and so the bonds go on the balance sheet of the Fed, and the Federal Reserve creates a deposit that goes from the primary dealer to the checking account of the U.S. government, so that when the money is sent out to the taxpayer, he gets a check that he can cash. But basically, the government is borrowing that money into existence by issuing a treasury bond that eventually goes to the Federal Reserve. There is now Federal Reserve notes in circulation, which are the dollars that we have, which are now liabilities of the Fed, and they're backed up by the treasury bonds that the Fed now has on its balance sheet. And that's how the balance sheet, exploded up to $4.5 trillion during quantitative easing, because the Federal Reserve bought up all these treasuries and mortgage-backed securities and replaced them with cash that is now circulating in the economy, and that was used to bid up, financial assets and things like that. But there's no real production of goods and services that are going on here. I mean, people have to realize there's an old saying that I forget, I think it was a president, I forget, but the government or the people have to support the government, but the government can never support the people. But today people think that the government could support everybody, that the government could provide free stuff. They can't. The government only has what it takes from the people. Now, it has various ways it can take it. It can do it honestly by just raising taxes on the people, but it can also borrow money, and the people don't necessarily see that cost, but they still bear it because they have to repay the loans. So when the government is borrowing money, it is simply deferring taxes to the future, plus interest, because the lender charges interest. Or if the Federal Reserve ends up monetizing the debt, quantitative easing, whatever they want to call it, and the Fed buys the bonds, then they do it by creating money, which destroys the value of the money that already exists. So people are robbed of their purchasing power instead of being robbed of their money.
Yeah, so that's a great explanation. And so now we understand how the additional money that's being printed by the Fed or being spent by the government gets into the real economy. But then to add to that, the situation that we have now with the coronavirus, I heard you say this on your podcast Monday, which was fantastic, probably one of the best episodes I've ever heard. But you talked about there being a supply shock. So we've got this additional money supply, potentially not just chasing the same amount of goods and services, but actually fewer goods and services, which would really spike that inflation for consumer prices. Can you explain that a little further?
Yeah, exactly. Well, obviously, due to the coronavirus, people are sick. and those sick people are not productive. But more importantly, there are a lot of people who don't want to get sick, or who simply don't want to spread a virus that they don't know they may have. So everybody is kind of isolating themselves and trying to interact less frequently with other individuals. And so people aren't going to work. People aren't, as productive as they used to be. So factories aren't producing as much stuff, or they're not producing the components that other factories need to make their stuff. So we're less productive. We're staying at home and taking some time off, right? So we're not making things. So what the federal government really should be doing is shrinking the money supply so that, we have price stability. If that's their goal, if we're producing less stuff, then we need less money, right? But what they're doing is they say, no, we want to give people more money. We want to put money in people's pockets. But what good is that going to do if there's less stuff for people to buy? So it just accelerates the inflationary process. I mean, what is keeping a lid on it is that the U.S. dollar is the reserve currency, and a lot of the money that we create just, ends up being exported. But if that happens to a lesser degree, I mean, our trade deficit's going to come down if the Chinese aren't producing as much stuff anymore to ship to us. So more and more of that cash is going to just stay around here. And what are Americans going to do with it? Well, they're going to the supermarkets, trying to buy food, stock up on food or other supplies. But eventually they're going to run out, and just prices are going to start to go up.
So you were one of the first people to call the last financial crisis that we had. And I think you started calling it way back in 2000, 2002. You're way ahead of that curve. You saw the whole thing happening from the front lines. And now you're seeing what's going on with this collapse. How are they similar and how are they different?
Well, I mean, first of all, what's happened with the coronavirus, I mean, I think the coronavirus, is acting as a pin for this bubble. But I think the bubble was already deflating before it found this pin, just kind of on its own. Once the Fed really started to hike rates, the fourth quarter of 2018, everything started to fall apart. And that's when the Fed panicked and reversed course and started cutting rates and just doing a stealth QE program. Or it really wasn't stealth. It was out in the open, but they just didn't want to admit that it was QE. And they're still being really coy. They don't want to call what they're doing QE.
Yeah.
It's exactly what they did before. And I don't know why, they're now so embarrassed about saying it's QE. If they think it did such a good job, I mean, why not admit that they're doing it again? But I saw this coming a long time ago. I mean, my book that I wrote, The Real Crash, which I wrote after 2008, was to remind people that wasn't the crash, that the real crash is the one that's about to happen because of the massive bubble that the Fed inflated after the bursting of the housing bubble. So to answer your question, the similarities and the differences between what's happening now and what happened in 2008, in both cases, you had credit bubbles that popped. In 2008, it was primarily a mortgage bubble. People had borrowed a lot of money to buy houses, and people had used their houses as collateral for a lot of other loans. So people took out home equity loans to go out and buy stuff, buy furniture, remodel, take vacations, pay off their credit cards. So you had a lot of mortgage debt collateralized by houses. And when the houses fell in value, which is something I was predicting would happen for years, then a lot of the borrowers who had stretched themselves so much lied about their incomes and all that to get a house because they wanted to get rich as a homeowner, because people thought housing prices would never stop rising, including the lenders, because the lenders were so confident that housing prices could only go up. They didn't care about the borrower because they knew they had the collateral of the house, right, which they thought would always go up. But once housing prices went down, the borrowers said, well, no point in making my mortgage payments. I mean, I have no equity. What's the point? I'm making my payments now. And so the banks were in trouble. That became a financial crisis. So when real estate prices came down, it became a financial crisis because of the credit. And now you had banks failing, you had the GSEs failing, and then we had all the bailouts. It was caused by the Fed. Had the Fed not left interest rates so low, all this mortgage debt never would have, existed. Had the government not guaranteed the mortgages, banks would have been much more strict about, the terms under which they loan money. But since so much of this stuff was guaranteed, they didn't care. And so today it's another credit bubble, right? Except now it's a bigger bubble. We have a lot more debt today than we had in 2008. And what is the pin? Well, the coronavirus now is substantially slowing economic activity for vast segments of the economy. I mean, obviously the most obvious, the airlines, Boeing that services the airlines, or companies that in a supply chain, the hotel and leisure, the travel industry, hotels, casinos. These are obvious casualties if people aren't traveling, but restaurants and hotels and a lot of businesses. The problem is all of these businesses have enormous amounts of debt. So the problem isn't that businesses slow down. The problem is that now the businesses that are highly indebted can't make their debt payments. Right. And the same problem exists for their employees, because when they try to cut back on their workforce because they have less business, now their employees miss a paycheck. Well, you now have record numbers of workers who are working paycheck to paycheck. They miss one paycheck, they can't pay their credit card bill. They can't pay their student loan. They can't pay their auto loan, their mortgage, or their rent, or whatever. And so that has a cascading effect. So this is another financial crisis. This is a health crisis becoming a financial crisis, whereas before it was a housing crisis becoming a financial crisis. But the reason that they're financial crisis is because of the debt. And why do we have all this debt? Because the Federal Reserve force-fed the money into the economy. They held interest rates artificially low. And so instead of deleveraging after the debt bubble popped in 08, we leveraged up even more and have an even bigger bubble. So the problem isn't the pin. The problem is the bubble that the pin pricked. And since this is a much bigger bubble, it's much worse. And now, instead of just bailing out the banks, they got to bail out everybody. I mean, every business in America is now going to Washington for a bailout, and pretty soon it's going to be the banks too.
Okay, so that was my next question. If you thought the banks were as at risk today as they are, or as they were back in 2007, 2008, everyone hears that their balance sheet, at least the U.S. banks, are a lot better now. But to your point, if everyone's defaulting on those loans at some point in time, that's got to flow back to the banks.
Yeah, and remember, everybody said the banks were sound in 2008. It wasn't until Lehman and Bear went bankrupt, even weeks before, they were saying everything is fine. So they can go back now and say, oh, the banks are in great shape. It's not like 2008, except in 2008, the same people were talking about how the banks were in great shape. Right. So, you can't believe them. In fact, when the Federal Reserve does these stress tests, I think they're engineered so that all the banks pass. I mean, they're not really putting them through the type of stress that they need. I mean, one of the circumstances that they've never tested was what happens if there's a recession, but interest rates go up. That's never one of their assumptions. They always assume that if there is a recession, interest rates will always go down. Well, what if they go up? What if long-term rates go up? No bank can withstand that. We have stagflation, and that's where we're headed. I think that there's going to be a currency crisis. The reason that the dollar didn't collapse in 2008 because of QE1 and 2 and all the TARPs and the various bailouts was because everybody believed it was a one-off thing. It was temporary, and that the Fed could unwind the balance sheet, normalize interest rates. But none of that ever happened. And now the balance sheet is blowing through the roof. It's going to be much bigger than it ever was before. They're back down at zero, just like I said they would for years. And now no one is going to believe that they can ever normalize rates. I mean, they couldn't do it last time. How are they going to do this time? Especially that since we have so much more debt now, the more debt you have, the harder it is to normalize rates. It's like, the more drugs you take, the harder it is to kick the habit, right? You got a bigger drug habit, and so it's more withdrawal if you ever try to stop taking the drug. So people are going to realize that this is a permanent situation of zero and QE, and inflation is going to really start to take off. And that's going to put a lot of downward pressure on bonds across the spectrum, not just treasuries, but muni bonds, corporate bonds. I mean, there already is pressure now on the corporate bonds and muni bonds, but it's going to intensify. And the Fed's going to have to print more and more money to try to buy up these bonds to keep rates from rising. They're going to have, one bailout after another. And eventually the bottom's going to fall out. I mean, gold's going to take off, and we're going to, go through massive inflation. It's going to be an inflationary depression.
Yeah. So one thing I'd like you to address, first and foremost, with the bailouts. I heard on your last podcast, I think you made a very solid argument for why that's not a good idea, and that the world actually wouldn't come to an end if we didn't have any of these bailouts, that the free market would handle that. Can you explain that further?
Well, sure. I mean, bailouts basically benefit the owners of the companies or their creditors, right? So people who bought stock and who loaned money get bailed out. But people think, well, like let's say now with the airlines, oh, we can't let the airlines fail because we need airlines. Well, if the airlines go bankrupt, the airlines are still going to be here. What happens is there's a bankruptcy, they go restructure, all of the current shareholders get wiped out, right? The stockholders lose their money. The bondholders then own the business, right? Now, what do the bondholders do with the business? Either they operate it themselves collectively or they sell the assets, right? Now, somebody is going to buy the assets. Someone is going to want to operate that airline, and they're going to come in with cash, and they're going to buy the assets with a clean balance sheet, right? And now they're going to operate the planes. They're going to own the airline, right? The people who ran it into bankruptcy, they get punished. They lose their asset. Lenders probably don't get made whole. They never should have loaned so much money to a company that was already so heavily indebted. So the people who made mistakes and did foolish things lose money, and now more responsible, people come in, take over the management of the company. Maybe they go public again. Maybe it's another public entity or a private entity. But the airlines don't go away. I mean, Americans want air service. Entrepreneurs are going to provide it, right? So they're going to buy up those assets, that infrastructure. Obviously, without the debt, the airlines could be very profitable. The problem is all the debt. Well, that gets eradicated during bankruptcy, right? But the other good part about this is that now the people who buy the airline know we better be careful with our balance sheet. We better not borrow too much money because if something goes wrong, we may not be able to weather that storm. So we better have a rainy day fund. We better be prudent. We better not over leverage. But the message that we send by bailing them out over and over again is just borrow as much money as possible. Don't have any rainy day fund. Act as if it's never going to rain, right? Just spend like crazy, borrow like crazy. Because when it rains, just go to the government. They'll bail you out. So that's moral hazard. And we don't want that. We've already created that. We have enough of that in the banking system with the deposit insurance. Everybody knows that if they can be as aggressive as they want, take as much risk as they want, because all of the market mechanisms that would rein in that aggressive behavior have been short-circuited by the government with guarantees and backstops and moral hazard. So this is all wrong. But, had we not bailed anybody out in 2008, yes, it would have been a more painful recession at that time. But now, because we did bail them out, the next recession is going to be far more painful.
Yeah, they would have been a lot stronger today. And then, so what's the argument for not bailing out the average Joe? As you said before, they're going to lose their job. They're not going to be able to make rent. And I'm not saying that I'm a proponent of this. I'm just trying to play devil's advocate so you can explain it. So why should the government not send them $1,000 a month till this thing blows over?
Well, the government doesn't have any money. The government has to borrow it or print it into existence. So where does that come from? The government only has the money it takes from the people. Now, if you're going to say, hey, we should raise taxes on the rich to give some money to the middle class, if that's what your plan is, so let's redistribute some money. But, the problem is people should be taking care of themselves, not relying on the government. That is what America is supposed to be about. We're supposed to be a nation of rugged individuals, not a bunch of freeloaders that are looking for a handout. And I just, made this example on my own podcast, and you can listen to it. People go to the Peter Schiff podcast. But I thought it was interesting that a lot of these politicians are referencing World War II. Kind of like, hey, we need a national effort. We have to come together like we did to fight World War II. We have to approach the coronavirus like it's a war, and we're fighting this war against this enemy. Right? Well, that's fine, but they don't understand what happened during World War II. Because if you think about it, World War II was more disruptive to the economy than the coronavirus. I mean, I can't think of anything more disruptive than the entire world fighting a war, right? I mean, we took 16 million men away from their families, away from their homes, and we sent them to Japan and Europe. Those are 16 million people that weren't going to bars, weren't going to restaurants, weren't taking vacations, weren't working their jobs. I mean, consumption collapsed during the Second World War. Auto sales were down 50%. Entertainment down 25%. Everything. People were at fighting. They weren't at home. So restaurants lost a lot of business. Hotels lost a lot of business. A lot of bad stuff happened. So what we did during the Second World War, which of course was no fault of anybody, right? No American citizen is responsible for the Japanese bombing Pearl Harbor, right? Nobody asked for that, right? But the government didn't say, hey, we're going to war, so we're going to send everybody a check so you have extra spending money. We don't want anybody to suffer. So, if you lost your job because your customers are now fighting a war, don't worry about it. We're going to give you some extra money just so you don't get hurt and make you whole. No. What the government said in World War II is, hey, the government needs a lot of money. We have to fight a war. So we're raising your taxes. We don't care about your circumstances. We are raising your taxes. In 1941, only 3% of Americans paid income taxes. 1942, 30% of Americans paid income taxes because they lowered the rates, they lowered the brackets and they jacked up the rates. In addition, they imposed all sorts of new taxes in 1942, the victory tax, telephone excise tax started, and a lot of taxes on consumption. So we tripled taxes on the middle class to pay for the war because the government gets the money from the people. But that wasn't enough. The government needed more money. So the government borrowed money from the people. The U.S. government sold war bonds. And the people, in today's dollars, middle-class Americans loaned trillions to the federal government so that they could pay for the war. So today, the government is saying, oh, the U.S. government is going to loan money to the people. We're going to make loans to businesses. We're going to make loans. What money? The government doesn't have any money. Right. Can you imagine if in 1941, if Roosevelt said, oh, don't worry, the government's we're going to cut your taxes, not raise your taxes. We're going to loan money to the businesses that are being affected by World War II. Well, then how would we fight World War II? Where would the government get the money for the tanks and the bombs and the planes? And how would we feed the troops? And how would we clothe the troops? Right? We needed the money. We had a Federal Reserve back then. Why didn't we just have the Fed print the money? Because it would have been hyperinflation and the Germans would have won the war right away. So, right. That was what America looked like when it was honest. But you got to ask yourself this. How did average Americans, how did middle-class Americans have so much money? We had just come out of the Great Depression, yet middle-class Americans had enough money that they could pay taxes that were triple what they were paying before the war. In addition, they had all this extra money to buy war bonds. Yeah. When today Americans have nothing. They're one paycheck away from bankruptcy. That's when we had a real economy. We were a powerhouse. That's when America was great. Trump never made America great again because America is never like what it was in 1941 when we were a nation of rugged individuals that actually had savings and resources that they could make available to the government in times of crisis. Now, everybody's living paycheck to paycheck. Everybody is loaded up to the hilt with debt. Nobody has any savings. And we all think the government can take care of us when they can't. All they have is that printing press, and they're going to use it, and they're going to destroy the value of the dollar. That is what's coming. That's why I'm so insistent with people, and I've been working with my clients for years to get them prepared because people are going to get wiped out. Anybody with savings, people that have money in dollars and treasuries and muni bonds, cash value and an insurance policy, everyone's getting wiped out. The dollar is going to crash. All the purchasing power that they're stealing to spend it into existence is being stolen from the savers. The bottom hasn't dropped out yet. We're printing all this money and everybody thinks it's fine. But it's going to happen. And so people need to get portfolios together, get their money out of dollars, own gold, own some gold stocks, own assets in foreign countries that have sounder economies where the currencies will not collapse completely, but you have real assets that pay dividends so that you'll have real purchasing power. Because people who are depending on interest and dividends in dollars, they're going to get wiped out.
Okay, so and we discussed earlier in the video how that actually works, from the Fed printing money, the government spending it, to creating the inflation that you just talked about, which is why you should own gold. So I know you're limited on time. Let me just get a couple more questions that I know my viewers are really interested in. Number one would be the gold price going down right now. You explained it really well with the margin call, but I don't know that everyone understands how that process works. So can you just quickly explain that? And then I'd like to get your thoughts on not only the dividend paying stocks outside the United States, but also the silver to gold ratio and why that's important.
Yeah, well, first of all, the price of gold is around, what, 1,500 and change right now, 1,530, 1,550-ish. This most recent bull move started really in January of 2016 with gold just above 1,000. And we peaked out at 1,700 early in this crisis. So we had almost a 70% move, 65% move up in the price of gold. And then we had about a 10% correction as markets started to implode. But, the stock market went down 30%, the small caps down 40%. So gold went down less than stocks. So people who were in gold, preserved a lot more purchasing power than people who were in riskier assets. But you mentioned silver. I mean, silver is at an all-time record low. You could buy more than 100 ounces of gold with silver. That's never happened before. So gold is gaining value relative to commodities, relative to financial assets. But yes, there was a rush to sell some gold recently. I think people needed money and they had to get it wherever they could. They had margin calls that they had to meet, not necessarily on gold, on other assets. And to meet it, they had to sell gold. They couldn't meet the calls with gold. They had to get dollars. And so I think there was some selling in that market. But, it wasn't, dramatic. And I think we might have already seen the lows in gold. And I think we're headed back up. I mean, just because it goes down for a few days doesn't mean it's not a long-term store of value or a long-term safe haven. Sure, anything can fluctuate in value on any given day, depending on the market. But I think gold is going much, much higher in terms of stocks. Gold is only down about 2% this year, whereas stocks down, 25, 30%. And I think by the end of the year, gold is going to finish much higher. I don't expect the U.S. stock market to recover these losses. It's going to have a down year for 2020. So, gold investors are doing much better. In fact, if you go back to the beginning of this century, year 2000, gold was under 300. The Dow was around, 10, 11,000. So the Dow is roughly doubled based on where it is now. And the price of gold is up fivefold. Yeah. So even with the dividends on the Dow, it doesn't compete with just owning an ounce of gold and keeping it in a shoebox. And I think that's going to continue. I think you're going to see gold continuing to gain value. Gold stocks, highly speculative. Gold stocks got clobbered more than non-gold stocks. I think, again, it's a less liquid market. So if you get a bunch of sell orders coming in, it's going to have a bigger effect on the way down. But of course, it has an even bigger effect on the way up. Look over the last 2 days. We've seen some of these gold stocks up 40, 50% off their lows in 2 days. So you have extreme volatility in these assets. If you can stomach the volatility, I think a lot of these stocks are going to go up 10 times, 20 times, 50 times over the course of the next 5 or 10 years as this bull market really gathers strength and as we go to this inflationary environment. So we actually manage, I don't manage it personally. Adrian Day is our manager, but we have a fund, a gold fund, the Euro Pacific Gold Fund that he manages. We also have separately managed accounts of gold stocks. I highly recommend that people contact us if they want to get into the space, especially in the junior miners. It's a very specialized field. In fact, most professional gold fund managers don't even understand this sector.
And is that applicable to silver as well? Or do you guys handle silver in your funds?
Yeah. We sell physical gold and silver at my company, Schiff Gold. But the mining stocks, we have the managed accounts at Euro Pacific Asset Management, Euro Pacific Capital. But I think we add a lot of value by having a manager that actually knows what he's doing. He's been doing it for 40 years, and he knows the sector. He knows the management teams. He knows, the good investments from the cons. I mean, there's a lot of gold stocks that are go to zero because they don't have any gold and they never will. But they have a story and people buy into it. But there are stocks that can go up, as I said, 50x. So we want to try to avoid the ones that go to zero, as many as we can, and get as many of those 10 baggers, 50 baggers as we can. So I think Adrian.
Can you speak to the dividend-paying stocks that? Everyone knows you for silver and gold and precious metals, but your company really researches a lot of these dividend paying stocks overseas that you pointed out on your podcast the other day are extremely cheap. So when you say they're cheap, what type of PEs are you talking about? What type of dividends?
Yeah,
And
I mean,
I
we're
make sure
talking
people know
about
that you're a
low,
specialist there too.
yeah, low double digit or high single digit PEs. And, the yields are in the higher single digits and low double digits as well, the dividend yields. And, a lot of the stocks that we've been buying are now, lower than they were in 2009. Now, they never had the big rally that the U.S. stock market had. So they were above those lows. But, this bubble was really concentrated in U.S. stocks and a handful of other types of names. But the value stocks, right, the dividend paying defensive names, nobody was really buying those. So they never really went up very much. Of course, they did pay dividends, and we've been collecting those. But when the stock markets crashed, everything crashed. The value stocks along with the high flyers. The difference is the value stocks should recover much quicker because when the dust settles and people are looking for yield because they can't find any in bonds anymore, and now you see these stocks paying 7, 8, 9, 10, 11% dividends, you're going to try to buy those. But of course, when everybody's trying to buy them and nobody wants to sell anymore, the prices will go up very fast. But the reason that I've been recommending dividend-paying foreign stocks to people who are, planning a retirement or who are already retired is that inflation is going to be the biggest enemy of retirees. The cost of living is going to skyrocket, and most people's incomes are going to be inadequate. But if you build a portfolio now of these dividend-paying foreign stocks, I believe the dividends will rise sufficiently to provide meaningful purchasing power for you. The dollar will lose so much value that when you translate your euros or your Swiss francs or your New Zealand dollars or your Singapore dollars or your Norwegian krona, when all those dividends are translated back into depreciated dollars, you'll have enough of them to buy the food that you need and to buy the other things that you need. But if you just have dollars, you won't be able to afford it. You'll have to go back into the labor force to earn the dollars because the value of the dollars you already earned and saved will be destroyed by inflation.
Got it. All right, Peter. Well, I want to be cognizant of your time. Thank you very much. You've mentioned a couple places where people can find you, but are there any other websites? I know you're trying to promote your YouTube channel, Twitter, anything like that?
Yeah, you can go to my YouTube channel, Peter Schiff. I put a lot of content up there, my podcast. You can listen to my podcast at schiffradio.com. I've been doing almost one a day here recently with all the extra volatility. People can read my books. Schiffbooks.com. I have some. You can buy most of my books now. They're pretty cheap on Amazon.com. I haven't written a new one, but you can pick up books like The Real Crash at quite a discount now on Amazon. But yeah, my brokerage firm, Euro Pacific Capital, is Europac.com. Euro Pacific Funds is EuroPacificFunds.com. So I have a lot of businesses where I help investors manage money. So you can try to get a hold of me if you have money that you want to transfer an account over. You can certainly follow me on Twitter. I've been tweeting a lot these days. Also on Facebook, you can friend me over there. Yeah, I mean, Twitter, I've really been doing more stuff there. I'm now almost up to 200,000 followers because I've been doing more tweeting. So,
yeah,
but we got to build that up because more people need to read what I have to say because there's so much nonsense out there. In particular, listening to my podcast because the mainstream media, the news is terrible on what's going on. So if you really want to know what's going on, you got to get it from a source like me or maybe a source like you.
Yeah, and I want to also point out before we go that it may seem as though just a lot of blue-collar guys or just average people are the people following Peter, but that's not the case. And the reason I know that, and Peter, I'm sure you've recognized this as well, whenever I hear you use an analogy, it's almost guaranteed that 2 weeks later or less, I'll hear Jeff Gunlock use the exact same analogy on CNBC.
Yeah, sometimes. Well, Jeff has gotten quite a few analogies from me, and I'm happy to help. I mean, look, he's a nice guy. I've met him. I've been to his house. I have a lot of respect for the guy. I do wish he would kind of credit me once in a while, but nobody wants to admit. I've joked that listening to my podcast is like watching porn. We all do it, but no one wants to admit it. So, and there's a lot more guys. Like I'll see other guys on CNBC. They won't have me on anymore, but I know they all follow me, and I'll hear them say something. I just tweeted that, but they never want to attribute anything to me, or they never want to give me any credit for anything. But I do have like a underground following of mainstream people, and every once in a while, they'll send me an email because I used to get people when I used to be on like CNBC a lot. People used to come up to me on the street and say, hey, I love seeing you on CNBC. The only time I turn up the volume is when I see you.
Yeah.
So they only just watched it for the quotes, but if they saw me, then they knew I was going to say something relevant or interesting at least, or maybe funny, and so they would turn up the volume. But of course now they don't have me on, so there's no point in ever turning up the volume. I just turn it up because I get material. You know, I get to make fun of them on my podcast or, you know, on Twitter.
All right, and also I want to give respect to your father. I know you still sell a lot of his books. Where can we find those?
Well, on Schiff Books, I sell the few copies we got left, and you know, again, there's some on Amazon too. But just go to schiffbooks.com.
All right, Peter. Thanks for being on the Rebel Capitalist Show. Can't wait to do it again.
Okay, take care.